What's up guys, welcome back to another video. Now let's jump in and see how we can spot and execute a directionally driven trade together. By the way, please make sure to watch this video all the way through so you can learn, if interested of course, how I do set up my sideways trading strategy and the steps that I take to trade it profitably. Alright, so back to our directionally driven trade concept now. So certainly identifying high probability trade opportunities can be tricky, but I do think that it is possible to spot them by closely studying charts and recognizing key indicators. With the right approach, patience, and certainly the right strategy, you can locate and execute potentially profitable trades. To get started, though, you should first keep a lookout for key patterns or trends. And speaking of trends, as you know, price movement can be found within two main market cycles: in consolidation and in trend. Now, identifying these price rhythms in your charts that emerge during different trading environments is obviously crucial. Reversal points, channels, and imbalances are also excellent places to begin your trade hunt, since these structural technical elements can offer, I think, some solid insight into the market's directional bias. We should also keep a close eye on key support and resistance levels, which could indicate favorable buy or sell entries for the duration of our trades. I think that with the right focus guiding your trade decisions, you will be able, as an active trader, to spot and launch high probability trades. Now, obviously, guys, there will be days, and initially there will be, believe me, many of them. That's why paper trading for noobs, I think, is a must. So there will be days when the market won't be on your side. The fact is, day trading involves calculated risks, and a certain degree of red ink in our P&Ls is unfortunately mathematically unavoidable. However, rather than give in to frustration and negativity, try to stay rational and channel any losses into a chance to learn. Use those red trades, guys, as an opening for improvement. Alright, so as we get back to the charts, as you can see from this 15-minute time frame, the market seemed ready for a move higher up here via this breakout attempt, but eventually buyers failed to make that leap of faith. As a result, we see the supply side take control and signal a rejection of higher levels over the 3870 mark. After demand failed to break through here, things, as you can see, quickly went south. So after a 60-point reversal and a correction into this imbalance zone here, which, if you notice, also coincides with our range's 50% fib retracement level, the price started to break some primary structural lows before actually finding a base, a strong one, I should say, via this sideways channel. Obviously, this breakout area over here should become your point of interest, since breakouts, particularly as a result of range-bound consolidation environments like this one, usually point to the possible start of a strong trading market in the breakout direction. When the price surpasses a channel support or resistance level, in this case, it typically signals an upcoming increase in volatility and creates enough momentum for the market to move towards that direction. That's why this moment of breakthrough of this directionally driven trade here is so important. That said, though, it is important to also be aware of fake outs or prices moving back within a prior trading range when engaging in breakout trades. That's why you must try to avoid gap and trap scenarios, and always wait first for confirmation before taking a trade. And the confirmation in this case, after this break of market structure here, would be price pulling back to close this 15-minute imbalance zone before jumping higher. This point right here, guys, would be, in my view, your entry signal. Now notice that the imbalance zone, though crucial, is not the only confirmation we have. We also have these major accumulation zones as a strong entry argument on our side. Additionally, we have no magnetic forces in play, if you will, in the form of other outstanding imbalances pulling the price toward lower levels. Equally important, I should say, since we are oversold in relation to our range's 50% fib retracement level, at the very least, we can objectively expect a decent scalp into this upswing here, which I've marked with a red horizontal line. So needless to say, these influences do suggest a long entry here. And clearly, and as the chart shows, the magnitude and velocity at which the price hits the first target of this directionally driven trade gives us not only a pretty strong consensus about the trade, but also proves our argument behind this analysis. Obviously, the second target with a trailing stop, which is a must, should be set into this imbalance zone up here, while the third target at the top of the range. All right, guys, I think it looks like we are done with this trade, so let's jump on to the next one. Okay, so taking a closer look at this 60-minute chart, the British pound USD pair seems to stand out. On the other hand, analyzing and predicting how this particular pair is going to move can be tricky, but with the right information and some good price action analysis, which speaks volume to me in terms of consistency, it's possible, I think, to squeeze a high probability sideways trade out of the pair. So let's see what we can uncover when examining this action more closely. Obviously, having a plan is always important, but when it comes to trading, having one is essential, if not crucial. My first step when it comes to spotting trades, like sideways trending ones, is mapping out a range. Even though market conditions can be volatile, setting parameters allows one, I think, to track real-time trading opportunities. I conduct price action analysis to identify potential risks, rewards, and strategies with which I'm comfortable. This way, I'm ready to jump on high probability trades while steering clear of those that don't line up with my set goals. I do think that having a plan helps me make educated decisions even when the markets are unpredictable. So having one is simply non-negotiable. The second step of the sideways trading strategy would be to identify a structural price action pattern. Following the mapping out of the range, this pattern can give you an even greater insight into the potential trajectory of the price. In this case, we got the formation of this nice bearish order block as our main structural reference pattern, which, and as you can see from the chart, after breaching this structural low here, makes its way beneath the 1.20 price floor, giving us a range and consequentially providing more conviction on the given direction. While it may not be 100% foolproof, using order blocks as your main structural pattern in your sideways strategy can really help to increase your chances of identifying high probability trades. The third step would start with exercising patience. Patience isn't just a virtue, but also a very helpful factor for achieving success with this technique. Also, guys, when going through this third step of the strategy, it's key, I think, to make sure that the price respects both the lower and upper boundaries of the range. This helps to secure a stable sideways trend with as little range deviation as possible. The less oscillative the deviation, the firmer the range. Now, while nothing can ever be absolutely guaranteed in an unpredictable and ever-changing market, keeping an eye on such technical details before considering an entry will most certainly increase your chances of a profitable trade. And here, you may be wondering, well, undercurrent, what is so unique about this strategy when most traders already know how to identify and enter price channels that contain a sideways trend? That's true, but here we are not talking about trying to buy when the price is nearing support and sell when the price is nearing resistance. While the concept may be the same, I think the approach is quite different. Now, our main focus here, guys, is the source of this bearish order block. This is the strategy's main artery, which is illustrated obviously by this rectangular area over here. Now, you should pay attention to how price here aggressively dips or reprices downwards once it enters into the block source domain. We don't have the same expansion, I think, or reaction here or here. I think that the contrast is pretty evident. This is why, and as I previously noted, it is important to stay patient with this strategy so that you can catch these high-intensity price stretches and rake in. And this brings us to another critical part of this strategy's third step, and that is we only take the trade if the price breaches the source of the order block. No breakthrough of the rectangular area, no entry. You can also apply the same rule if you want to go long by using the base of the range as a guide, but personally, and that's just me, guys, personally I like to match a bearish order block with a bearish trade. And by the way here, please do not confuse the sideways trending strategy with supply zones. We are talking about two different animals. I'll do a video at some point on the subject, but the short version of the approach is that there is no fast impulsive move out of the order block's base here to qualify this area as a supply zone. This is why, and unlike the supply zone strategy, we can easily here duplicate or even triplicate our entries if we want with this type of approach. As a fourth and final step of our strategy, when prices cross the order block's origin, we must refine our entry by zooming into a lower time frame. My go-to is usually 1 minute charts for this process. Now that we have switched to this specific time frame here, the question is, how can you figure out whether a recovery is in store or further losses are to be anticipated? Looking for imbalances or other structural price action elements is a great starting point. In fact, based on this price direction, a balancing dive into this inefficiency zone here can provide some insight into upcoming price movements. Specifically, in case of a downtrend continuation, it is possible to anticipate a break in market structure as the next step, which, as you can see from the chart, was followed by a nice bounce into this imbalance zone. Now, an entry into this inefficiency area would have provided a nice short opportunity. But since 1 minute time frames can be dubious at times, the best way to confirm an entry after this second break of market structure would have been, in my view, through this 5 minute inefficiency area, which I have marked with this rectangle. Obviously, these are your price targets, while your stop loss goes up here. Alright guys, hope you all learned something valuable from the video. Thank you for watching, and until next time.